Hey everyone, and welcome. Today we're going to do something really cool. We're going to learn how to read the story that financial charts are telling us. Seriously, think of it like learning a new language. And by the end of this, you'll be well on your way to speaking it. If you find this helpful, do me a quick favor and hit that like button, and subscribe for more breakdowns just like this one.
So let's kick things off with this really powerful idea. What this means is that technical analysis isn't about some secret formula or some guru's hot tip. Nope, it's a skill. It's based on data and patterns that are right there for everyone to see. The power is literally in your hands to look at a chart and figure out what's going on.
So, how are we going to learn this new language? Well, here's our roadmap for today. First, we're going to start with the absolute basics, the letters, the candlestick alphabet. Then, we'll see how those letters form words with simple patterns. After that, we'll add some grammar or context with indicators. Then, we're going to zoom out to see the bigger story in major chart patterns. And finally, we'll wrap up with the single most important rule of all. Let's get into it. Okay, let's start at square one. Every single language has an alphabet, right? Well, in the language of the market, our alphabet is made up of these little things called candlesticks, and each one is a tiny but crucial piece of a much, much larger story. So what in the world is a candlestick? It's actually a super simple visual summary of what a price did over a certain amount of time. The thick part, that's called the body. It shows you where the price opened and where it closed. Those thin little lines sticking out, those are the wicks, and they show you the absolute highest and lowest points the price hit. And the color? That's your easiest signal of all. Green means the price went up, red means it went down. Simple as that. All right, so once you can read the individual letters, the candlesticks, you can start to see them form words. And in technical analysis, these words are just simple patterns, usually made up of 1, 2, or maybe 3 candlesticks right next to each other. But don't let their simplicity fool you. They can give us some really powerful signals about what might be coming next. Take a look at this. This is a clear power struggle playing out right on the chart. On the left, you've got the bullish engulfing pattern. You see that massive green candle just completely swallowing the little red one before it? That's a huge sign that the buyers just stepped in and took total control. And the bearish engulfing on the right? It's the exact mirror image where sellers just overwhelmed the buyers. It's a visual tug of war, and it tells you who's winning. Now here, the shape itself is literally telling you the story. Look at the hammer. That long lower wick shows the market tried to push prices way down, but the buyers stepped in and hammered them right back up. It's a sign of strength. The shooting star is the complete opposite. The price shot way up, but was immediately rejected and pushed back down by sellers. That long upper wick is a big warning sign of potential weakness ahead. You know, just having words isn't quite enough. You need grammar to really understand the full context, right? Well, in our market language, indicators are the grammar. They're these fantastic tools that help us understand things like momentum, trends, and the energy behind the patterns we're seeing. So what are they really? In simple terms, indicators are just math formulas that are applied to a stock's price data. They get plotted on the chart, usually as lines, to give us some extra insight. Some of them try to lead the price, kind of like high beams on a car, hinting at what's up ahead. Others lag behind, more like looking in the rearview mirror to confirm the trend you're already in. Let's break down one of the most common ones, the simple moving average, or SMA. It sounds technical, I know, but trust me, it's incredibly straightforward. Here's how it works. You just pick a time frame, say 50 days. You add up all the closing prices for those last 50 days. Then you divide that total by 50. That's it. What you get is a single smooth line on your chart that cuts through all the daily noise and helps you see the real underlying trend. Okay, another super useful indicator is the Relative Strength Index, or RSI. The easiest way to think about it is like a speedometer for the market's momentum. It's on a scale from 0 to 100. And as this table shows, if the reading goes above 70, it suggests the asset might be overbought, like the engine is overheating, and it might be due for a price drop. If it dips below 30, it might be oversold, running out of gas, and could be due for a bounce. It's a fantastic tool for getting context on just how strong a price move really is. All right, we've learned the alphabet, we've learned some words and grammar. Now let's zoom out and start reading entire sentences and paragraphs. These are the major chart patterns. They form over weeks, sometimes even months, and they tell a much, much bigger story about where the market might be headed.
But before we can get into those big patterns, we have to understand the playing field, and that's defined by support and resistance. Think of support as a price floor, a level where buyers just seem to always show up and keep the price from falling any further. And resistance is the opposite. It's a price ceiling, where sellers consistently take control and stop the price from going higher. These levels aren't magic. They're created by the collective psychology of the entire market.
And here are two classic major patterns that you'll see all the time. On the left, you've got the head and shoulders. You see those three peaks? This pattern often signals that a nice uptrend is running out of steam. And when the price breaks below that baseline, what we call the neckline, it's often a strong signal that a downtrend is starting. The inverse head and shoulders is its optimistic twin. It's just flipped upside down and signals the potential end of a downtrend. Seeing one of these can be like spotting a major plot twist in the market story.
Okay, we have covered a lot of ground. We've gone from looking at a single day's candle all the way out to patterns that take months to form. But now we're at the end, and we've come to what is, without a doubt, the most important takeaway from this entire explainer. And please, if you remember one thing, let it be this. This is not magic. Technical analysis is not a crystal ball that predicts the future with 100% accuracy. Its real power is in helping you understand probabilities. It's about using the patterns of the past to give you a statistical edge so you can make smarter, more disciplined decisions about the future. It's all about tilting the odds in your favor. So I want to leave you with this final thought to chew on. If every candlestick, every pattern, and every single line on a chart is just a visual record of the collective hopes, fears, greed, and anxieties of millions of people, then what is the market feeling right now? The beautiful thing is, the charts give you a way to start answering that question for yourself. I really hope this gives you a solid foundation to start reading that story yourself. If this explainer helped you out, a like and a subscribe would be amazing and helps us a lot. Thanks so much for watching, and never stop learning.